Hello there. Welcome to IE Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I am your host, Rose Marcello, and I'm a Senior Director, Client Portfolio Manager at IEGAM. I have with me today Jean-René Adam, who is Senior Vice President, Head of Public Equity. He leads both the fundamental and quantitative equity strategies at IEGAM. Today, we are discussing the current bull market in the US, the AI frenzy, and his outlook for oil and energy. Good morning, Jean-René.
Good morning, Rose.
So I'll start with the famous bull market in the US. We had a difficult 2022, but since about 10 days now, we are up 20% versus the through of the fall. What do you think of that rally? Do you think it has legs?
Yeah, I haven't really changed my bullish view on the stock market that I had since the beginning of the year. And the reasons haven't changed either. So I feel that we are in a much better situation than last year, both on the inflation and interest rate front, which are really the two elements behind the 2022 correction. So remember a year ago, inflation was at close to 9% and rising. Fast forward today, inflation is at 4% and going down. In fact, it's been decreasing each of the last 11 months. Now let's look at interest rates. A year ago, the Fed was just starting to increase interest rate and many aggressive increases were needed. Fast forward today, interest rates are very close to the top, if not at the top. So these were the two main reasons I was bullish, and that hasn't changed. Another reason was that there was a consensus on the street that we would have a tough first half of the year. So all portfolio managers were positioned very defensively, taking very little risk, which was telling me that the market was already priced for a bad first half. So now I'd say the only thing that has changed from my prior scenario is that the economy is much more stronger than I thought, and that we may be able to avoid a recession now, which was not my base case at all. So this made me rethink my scenario of a tougher second half of the year on the stock market. And now I think that this is telling me that this bull market has leg.
So economy is a bit stronger than you expected, and most of us expected actually, if we're going to be truthful about this. But we just had a negative print in Canadian labor. Are you worried at all that this is the start of a trend? We're about to lose more jobs. And if so, what could be the impact for consumption?
Yeah, so I'm not really worried. In fact, I would be worried if the job market would continue to be strong. So that would mean more wage growth going forward and probably more interest rate increase. So I do feel we all agree, I think, that the job market is really tight. So the fact that we have some job loss is kind of a good news, I would say. And in terms of consumption, we still, obviously it wouldn't be positive for consumption. But on the other hand, we have so much excess saving following, the pandemic, and there's still, billions of dollars in the consumer's pocket. So I'm not worried on consumption either.
And, since the beginning of the year, if we look at the S&P 500 and we even look at that big bull market rally, it's mostly driven by the tech sector. Are you worried or concerned at all? This is mostly a tech story?
Yeah, not really. I mean, it's true then that when you look at the S&P 500 year-to-date performance, most of it comes from what they call the Magnificent Seven, composed of Nvidia, Meta, Amazon, Microsoft, Google, Tesla, and Apple. So these seven stocks also represents almost 30% of the S&P 500. And really, there are two ways to look at it. There's a bearish and a bullish way. So the bearish way would be to say that it's not sustainable and that the rally lacked depth. If you're more on the bullish camp, we'll say that the laggards will eventually catch up and join the rally. And so I'm more on the bullish camp. And maybe to come back on technology stocks, they are really benefiting from aggressive cost cutting that is creating very strong cash flows for these companies. And on top of it, they are also benefiting from the AI hype.
Yes, the famous AI hype. So speaking of the AI hype, we all have been using this. We've all marveled at it, something that we didn't even we weren't even thinking about it 6 months ago, and now it's like all we speak about. Are we in an AI bubble? Is it like a story like 2000 when the tech bubble bursted?
Yeah, I don't think we are in an AI bubble, but I do feel that it has all the ingredients to become a bubble at some point. It's really a technological advancement that is, I would say, as important as the cell phone or the internet. Everybody talks about it, but it's really when you try it and you start using it that you realize all the potential of this new technology. So our equity team is now using AI in their day-to-day job, and the productivity gain is just astonishing. Most of our strategies have also investment that are tied to AI, and we still see strong potential for these stocks. So, but as I said, I wouldn't be surprised if at some point it turns into a bubble.
I'd like to shift gears a little bit and speak about oil and energy. We've seen like oil and energy has done kind of a return, a mean reversion, a bit like what the tech sector did in the other direction. Um, Prices are down. We've also seen that China, we were expecting like a big reopening boost to the economy, both internal and even global economy. It hasn't happened. They're even stimulating their economy right now. What are the implications for oil and the Canadian stock market?
So, we've been pretty bullish on oil for the last 2 years, as you know. I think we're less bullish now than we were. I think the environment has really changed for the worse, and OPEC is kind of fighting an uphill battle. As you just alluded to, China's reopening has been disappointing to say the least, and is not contributing to oil demand. At the same time, oil production has surprised on the upside, especially from Russia and Iran. This has left OPEC trying to stabilize oil price. But as the spare capacity increases more and more, this is keeping a lid on oil price, and it's certainly not a bullish environment. So I do feel this will limit the performance of the Canadian stock market, as this is such a big share of the index. And although it's very cheap and the downside is limited, we still need a catalyst so that it catches up with the S&P 500.
Okay. So a bit of different story than what we're imagining for the past 2 years for Canada. We're halfway through 2023, almost the end of June. What's changed? Like if we were to conclude on what's your outlook for the rest of the year, what has changed? How would you define that?
Yeah, so the outlook is similar. Again, the only surprise we've seen lately is kind of a stronger economy than what we thought. So we thought strong first half, maybe more difficult second half. Now that we're probably be able to avoid a recession, or likelihood of avoiding a recession has gotten higher, I'm not more bullish than I was for the second half. So I still think that the stock market will continue to go higher, and not at the same level than it did in the first quarter, where S&P 500 is up 15%. But I do feel that the trend will continue.
Great. Well, thank you so much for being here today, JR.
Thank you, Rose.